Welcome, everyone. You're listening to Nephology, the podcast dedicated to crypto, accounting, business, finance, and much, much more. I'm Joe David, the founder of Nephos Group in Minor. Please note that all conversations recorded are professional opinions, and if you'd like to know more or gain support, please reach out to the team directly. Now, on to the next episode.
Hello and welcome to the Nephology podcast, episode 3 for our mini-series with Robin Thatcher, the managing director of By the Books Accountancy, joining us once again. Robin, good to see you for the third time.
The third time, yeah. Good to see you too, buddy.
How lucky are we? So this episode is going to be around the more complicated scenarios within the crypto tax space and of course the accountancy space as well. And I like to segregate tax and accountancy because it has its own issues, and just try and give us a more higher end conversation, because we have started from the very beginning, then we move through the practicalities and the logistics of it all. Let's talk about the tax planning element and the harder to account and tax for situation, Robin, if you're happy to.
Yeah, definitely. Let's get into it.
Wonderful. So the first one I want to talk about is negligible value claims. What is that? How does it work? Is it appropriate? And that sort of vibe. What are you thinking?
So I think on this subject, we'll probably not have different views. I think our businesses may take different approaches. Now, everything to do with these things is all down to research and down to interpreting HMRC's rules. So HMRC's rules, negligible value claims, are basically when you have an asset that you still hold that has some level of value, we can deem it a negligible value. So therefore, we can treat it as a disposal and therefore write the cost of that asset off against our taxes for that year. So for example, if you had a coin using software, you had a coin that rug pulled, the likelihood is, although that coin is rug pulled, there is still a value to that coin. It might be 0.00001 cent, but you have a value of it. So a software would interpret that you still hold it and you are holding an unrealized loss. So what we're effectively doing is forcing that loss one way or another and saying that we're going to offset it against our taxes. HMRC's rules on negligible value claims are that you need to write to them. Now, this is where I don't know if you take the same approach I do. I will write to them via the tax return. So I will put it on a tax return as a free type box under the crypto assets element, and I will say, this is the negligible value claim that has been made. I will try and separate it out as detailed as possible. I always go that with the more detail you provide, the more, if someone reviews it, they think they know what they're talking about and they're happy, they've done their due diligence on it. It's not we can do anything we want. There has to be an element of evidence to it. You'd have to be able to evidence it to HMRC if they're ever asked. You can provide, I don't always attach to the tax return. You can make attachments to the tax return, but the free type box is what I use mostly, which is where I'll put the detail of what the asset is, what the claim is that we're making. And then as long as you, in the future, if that asset ever rises from the flames as a phoenix and comes back to life, it would be 100% gain on anything you made from that. Because you've already claimed the cost, as you can't claim the cost again. So that's that.
Sorry, we're in the exact same position, Robin, in terms of negligible value claims. I believe the criteria off the top of my head is that it is of negligible value, which means it's significantly less than you purchased it for, and it is unlikely to ever bounce up again. Now, both are very subjective, so it can be denied by HMRC, of course. But as long as you adhere to those two, you should be able to make the claim. And it ignores the pooling mechanism, Section 104 guidance and legislation, so you kind of dispose of it and purchase it back in the same day, ignoring those rules, which we'll touch upon later, thus crystallizing the unrealized losses you've mentioned. So it's certainly something I believe everyone should be looking into, because like you said, there's rug pulls. Many people are subject to that. There might be just a failed coin or token, perhaps, or an FT. Perhaps you've got some locked away in FTX. That could be subject to a negligible value claim because your beneficial ownership of the asset, the value of that has gone down because you don't own it anymore, for example.
Yeah,
So it just
definitely.
get quite complicated. Robin, I've just had an epiphany. I'm not going to lie. You look like a smart version. Not, I'm going to insult this guy now. Of Eddie Hall.
That's not an insult, mate, but well, I'll take it.
Like you've got the beard and the hair and the sort of tattoos and everything. Ah, yeah, I'm covered in tattoos as well. But I feel like you're like like an alternate universe version of Eddie Hall, and it's just come to me.
I used to power lift back in my day, but not
Did you,
anymore.
did you really?
Yeah, I did. Yeah, I used to love it, mate. I used to love it.
Are you sure you're not his long lost brother?
No, he's a bit stronger than I am. I have read his book. I like Eddie Hall. I've got no problems with Eddie Hall. But yeah, I've read his book. I like the guy. I'm very much Eddie Hall's camp rather than Thor's camp, if you know what I mean.
Okay, that's fine. As long as I haven't insulted you. I was just looking at you while you're talking. I was like, you look like Eddie Hall.
I don't take that as an insult, mate. I've been called much worse. Trust me.
You and me both. So, moving on from lookalikes, tax loss harvesting is another thing I want to touch upon. I mean, we have banged on about this for the last 3 months leading up to the end of the tax year, 5th of April in the UK, and it's a little bit too late to tax loss harvest for the 23 tax year. But can you give us a rundown of what it is and how it's appropriate?
Yeah, so tax loss harvesting, generally speaking, just means you're harvesting any losses that you might be holding. So if I bought Bitcoin in I've lost what year we're in, but say I bought it at the end of 2021, and it was worth less today, I would have a loss, which is called an unrealized loss if I'm still holding. Potentially, I could sell that asset and realize that loss. Now, we go into the complexities then of bed and breakfasting or the 30-day rule, and how you can't buy it back within 30 days. Otherwise, it doesn't really count as a disposal because you've effectively just done it for tax purposes. But you can realize the loss by selling the asset and therefore crystallize that loss, and it becomes part of your tax calculation for that year, in a nutshell.
So, just to be clear, the difference between negligible value claims and tax loss harvesting is one is a proactive tax planning and the other is a reactive, because you can do it in hindsight, i.e. the negligible value claims, if certain criteria are met. And I find it a very weird and unique position to be in, where you can effectively create losses at a later date but backdate it to a point at which it was worth of negligible value. So that tax loss harvesting, I just want to be very clear about the differences between the two, because some listeners might go, well, they sound pretty much the same.
They do, but at the same time, like you say, the negligible value claim, the words you used earlier were very, very specific. Unlikely to return to any value. Well, you can only know that after a period of time anyway. It's not something that you can proactively forecast for. So it's very key, and importantly, it's going to be reactive to something that's happened, whether that be news that the project is dead, whether that be a period of time where the project has gradually died, and you've probably thought, well, I'm going to hold on to it in case it comes back. You will reach a point, whether that's 3 months, 6 months, 12 months down the line, where you will pretty much go, yeah, that's negligible value now, it's gone and it's not coming back. And then, you're in that scenario where it's unlikely to return. If it was 2 weeks, you can't really say it's unlikely to return unless you know that something has happened seriously within that project.
No, that makes sense. So yeah, this episode is all about the more difficult situations and scenarios a client might find themselves in, or an accountant might find a client in and need a bit of a hand with. So I want to talk about the more difficult protocols within the crypto space, and we'll start. We'll start light. I know as a team in Miner, it's something we are focusing on. Liquidity pools. Now, liquidity pools are becoming more and more popular, if I'm honest, in the last year or so, than ever before, and it comes with its own issues, I guess. Do you want to give us a rundown of liquidity pools and the tax treatment and all that lovely stuff?
Yeah, so they do come with their own issues. They're complex again from a tax point of view. They're becoming more popular, I think, because people are generally thinking that crypto might come back in a year or two from where it was, and therefore they're happy to lock their money up for longer periods of time to gain some sort of element of return on it. It's difficult for me to summarize liquidity pools. What would you it's so broad. I mean, even I'm struggling with that one. How would you summarize it?
Oh God, I would say it is staking on steroids is what I would going back. Yeah, yeah, I would probably go with that sort of comment on it. It for anyone who accountant or investor wants to know more about it. Honestly, just Google liquidity pools and impermanent losses, and it's an absolute rabbit hole of mystery. So definitely don't take them lightheartedly, whether you're doing your own taxes or you're an accountant trying to do someone else's. We could do a whole series on liquidity pools and still scratch the surface. It's that complex, but yeah, it's staking on steroids. We'll go with. Um, the other things as well that I want to touch upon in this and get your opinions and views is nodes. I know you mentioned in the previous episode you've had some dealings with some nodes before. Care to explain to our listeners in case they haven't heard of nodes, especially potential accountants trying to deal with this? What is it and what are the problems with it?
So first and foremost, I'll say there's different types of nodes. There's what I'd call me personally. This is me lingo. No one else's. Real nodes and fake nodes. Real nodes would have some sort of something somewhere that physically exists. Fake nodes were the ones that came out sort of strong, Thor, all of these things where they were. Look, let's call them what I think they were, which is a Ponzi. They effectively worked on the basis that as long as people kept consistently investing in them, they could generate returns. That is exactly what a Ponzi scheme was. If you read up on, I think his name was Charles Ponzi, and what he did, it was effectively a scheme that as long as it kept growing, he could keep giving money back to people at the bottom end of the chain and taking his bits off the top. So those are the fake nodes that I'm talking about. The fake nodes, they had I would call it node season, late 21, probably, between April 21 and sort of the end of 2021. They generated a lot of money for some people. It was a real interesting time. I think I spoke to you, Jamie. I certainly spoke to Joe multiple times on the tax treatment, and I went full circle with it. You know, I at first I was adamant they were capital gains, and I think there was. Don't get me wrong. I think I had a measured argument for it. But I think quite clearly the guidance now sort of squashes that and clearly sort of states that it would fall under that income tax, miscellaneous income sort of sector. The great point about that, though, is that you can offset costs against it. So what a lot of people were doing was compounding and compounding and compounding, and they might never have taken money out. Again, goes back to the point we made before. It doesn't mean they didn't make money, but it means that they're on their tax return quite often they would have a significant amount of gain, but a significant amount of cost against that gain.
Yeah.
The other advantage of that was you can add other expenses in because it becomes like a self-employed business. So you can add, if you bought computers or equipment for those sort of things, you can add that in. Accountants' fees become allowable within that. Things like that suddenly become a lot more allowable. But they were treated in a way that they would fall under miscellaneous income. You could allocate the costs against it. Very, very complex from an accountancy perspective to have auditable backup to them. From my perspective, anyway, software doesn't pick it up right. I've not seen a case where software did pick them up right. If I'm completely honest,
I've never seen it pick up right. We always have to make an adjustment for, as you mentioned, the compounding element. So
correct.
The software will pick up the capital, which, if you held them, I guess, when it came back out, whatever token it was or coin it was under, yes, there would be, but it never took the base cost when it came back out. If you reinvested, say, immediately as the expense, thus reducing your bottom line, your profit. Which, if you do this wrong as an accountant, you can cost them a lot of money in tax incorrectly.
Yep. So that was one thing that's really important, and I think this would be one of the cases where I'd say to someone, not only do you get an accountant that knows what they're talking about, pay the money that they're probably going to expect you to pay, because it's not an easy scenario. There were certain things out there, certain softwares that helped a bit more, but you are at the mercy of that software sometimes, and certainly some accountants would not be comfortable with taking that element of risk, because there is an element of risk with relying on unknown softwares to give you the detail that you're looking for. But yeah, they were yeah, they were a nightmare from an accountancy perspective, because not only did people make a lot of money off them, they potentially had a lot of tax to pay on them as well, which people didn't really factor in. It goes back to what we've said in the last episode about almost the money not existing. And people didn't see that. They knew they were making big sums, but they almost thought it didn't exist because they thought this was going to continue and carry on forever because of, I'm not saying rightly or wrongly, their belief in the project. But when that never materialized, people were in a position where they might have put everything into it and still made, still owe tax when coming out of it.
Yeah, and if a client ever tells me they've got nodes, my first question is how many? Because there could be multiple different types of nodes. And then the second question is how many transactions relate to it? Because you could have been in and out very quickly. You could have been in it for a long time, reinvest, and it's just an absolute pain. The other sort of type of asset I always link to nodes. They're nothing alike, but they have a similar level of issue, is rebasing tokens. Now, I don't know many accountants that actually know what they are, let alone how to treat them, if I'm honest.
I'm not, so I know what they are, but I've not had many instances where I've had to deal with them. And being completely honest, it was probably that long ago that if you said that to me, if a client came to me now and I've got a rebase token, I'd go away and say, yeah, give me a couple of hours to just look at it tonight while I'm sat on the sofa. Because it's one of those, it doesn't flow off the top of my head.
Yeah, rebasing tokens, we've had a couple of those, and we've had to really sit down several times as a team and go, right, how are we dealing with this? And the reason why, and I'm trying to tailor this towards accountants more so than investors, and the reason why it's got a problem is because rebasing tokens with normal cryptocurrencies, crypto assets, shall we say, the value fluctuates. We know that. The crypto space, the value fluctuates ever so much. With rebasing tokens, the quantity fluctuates, not the actual value. The value would fluctuate to a certain degree, but nowhere near as much. So you can imagine what happens when you've got 10 of these tokens. Next thing you've got 12. Next moment you've got 15. Then you've got 25. How do you account for that? It's very difficult. We have agreed on a way, and we've spoken to representatives of HMRC, and we've suggested this is how we're going to do it, and they said they don't have a better idea, is the nutshell answer. But it's certainly something that I think if you're an accountant and you see this, don't expect it to be straightforward. By all means, look it up and see how it works out, and try and come up with something new on your own, or come to someone who's a specialist. Now, going from that, we're going to move to something I'm quite passionate about, Robin.
I think I know what's coming.
Section 104 pooling. Now, Section 104 pooling. How can we, in a nutshell, explain what this is to our listeners?
Pooling your assets into one cost base?
Yeah, so average cost base, I suppose, is another term for it.
For the same assets, it's important to say.
Assets, yeah. So in America, they have LIFO, last in, first out, FIFO, first in, first out. In the UK, we have the average cost basis. So what that means is, if you buy assets on day one, call it Ethereum, £100 worth for 5 Ethereum, but then you buy 5 Ethereum a month later for £200, you average the cost per Ethereum. So we've got £300 for 10 Ethereum, for example. So we'd have a cost basis of £3 per Ethereum, nice and easy. Now these pools happen on a 1-day basis, then within 30 days, and then everything else. Now, does this apply to crypto? Yes, it's a short answer. Yes, it does. Coins and tokens would be pooled depending on when you purchased it or disposed of it, etc. Fine, not a problem, fantastic. Now, does it apply to NFTs? Now, that is an interesting question. Fundamentally, it can't, because each NFT is completely distinguishable from the next, so you can't really pool them together. It's like pooling Bitcoin with Ethereum. It makes no sense. Even if they're the same sort of series. There's a question as to whether the bed and breakfasting rules, i.e. if you sold an NFT, if you purchased an NFT on day 1, you sold it on day 50, but then you repurchased it on day 55, does it still come under the pooling, therefore subject the latest transaction, i.e. the repurchase, to the penultimate transaction, i.e. the sale. Now that sounds ridiculously complicated, but the ramifications of that is incredible, because if it does, you've reversed this tax loss harvesting that we were talking about earlier on with Robin. If it doesn't, is it something perhaps we should be looking into? Now, I know many accountants, very reputable personnel within the space, who say that you can actually do that and it does not adhere to the 30-day rule. However, I've seen exactly the legislative pieces that they're looking at to suggest so, and I get it and I agree. But I believe that there is an overarching anti-avoidance mechanism, again, I can't remember what that is off the top of my head, that would say actually it's caught out by that and therefore subject to the bed and breakfasting rules, and it would apply. So in my personal opinion, Robin, and for our listeners, I think this is one of the most complicated areas because there's no specifics in the legislation at the moment, and there certainly isn't any guidance. So it'd be interesting to see how this pans out going forward, to be honest with you, Robin.
I think it's one of those areas where, as an accountant, you have to tread carefully because there's almost no case law, so you almost have to use your judgment. And
Well, there isn't any case law for NFTs.
yeah, so the difficulty is no one wants to be that case law, but someone is going to be, whether we like it or not. So you have to tread very carefully and use what I would call it's judgment. It's the right judgment to ensure that HMRC are getting the right amount of money. So you're not defrauding them in any way, and ultimately you can then comfortably walk away, and if ever asked the question, you can demonstrate why you took that approach.
Yeah, I think that's spot on, and that's exactly what I would do with my clients. It's just, yeah, it's a very interesting topic. My personal opinion is that I'm not sure, so let's be safe and say it does adhere to it, because if it does, you're safe, and it doesn't, you're still safe. For those who are saying that it doesn't, I don't think it's a hard and fast rule. And if HMRC turn around when they go, actually, it always did, you're in a bit of a predicament there where it changes the figures completely. So it's certainly something that we should have in the back of our minds anyway. So if any of your clients, for those accountants listening, or if you're an investor, are thinking about tax loss harvesting for NFTs, perhaps something you wanna discuss with your accountant, to be honest, and go with that.
Yeah,
Really.
definitely. If you've got about 4 hours of your life and you fancy talking about tax for it.
Your specialism and your passion, I guess, in terms of this type of topic is around incorporating, I believe.
Yeah, so in a past life, in practice, I incorporated a lot of businesses. I incorporate businesses now to help people. Obviously, I charge for that, so it's not a service I advertise because I don't make a lot of money on it. It's simply I'll help people incorporate if they need my help. But the advice I will give is really important because incorporation, there's no hard and fast rule. There's nothing that you can write in terms of when is the right time to incorporate. People try to, but there isn't. It's down to everyone's individual circumstances and understanding what variables might be in the equation in terms of earnings, employment, etc., etc. So I think the hard and fast rule I use with people is if someone in the crypto world comes to me and says, do I need to incorporate? I ask what type of projects they're in, because quite simply, if you're only paying capital gains, I don't think there's an advantage in capital gains in putting it into a company, because you're paying 20% at the higher rate in your back pocket. You're going to pay 19% corporation tax in a company at the moment. If you're under 50k, you're going to pay 19% corporation tax, and then you're going to pay personal tax to take that money out of the company on top. So you're going to end up over the 20% anyway. So unless there's another factor involved there that might be at play in tax terms, that might help you. Some people do it for income purposes because they make capital gains every year and they say, right, I need to incorporate because I need to demonstrate it as profit rather than capital gains, because mortgage advisors and lenders won't take it as income. They take it as totally separate.
Yeah.
So people do consider it from that perspective. And there are other scenarios, but from overall perspective, capital gains, there's probably no need. From an income perspective, it depends on future plans, it depends on size, it depends on, like I say, your own circumstances. There's so many variables, so I'd always say speak to someone. It can be worthwhile incorporating if you've got for example, mining. People get mining rigs and make a decent amount of money off mining. If that's the case, it makes sense to have it incorporated. First of all, either way you can put the costs against it, but because the income and revenue might come in and you're constantly going to reinvest it, you'd rather have that in a company structure so that when you reach that point and hopefully your revenue is significant, it's in the right place, and that might make sense. But it's really, really down to personal circumstances and speaking to the right person and getting advice and ensuring that you understand the advice that you're getting, because you have to understand what's in front of you. One of the biggest things that people don't understand is the difference between what can be personal tax costs from accountancy going into business tax costs for accountancy. It's a lot more structured. You have to create statutory accounts. You have to have software all involved in that. I appreciate from a crypto perspective, they're both quite complex, but there may be more cost involved. So it's important to factor that in. But overall, there's certainly scenarios where incorporating can make sense. But it's making sure you understand that decision and you make an informed decision for yourself, not for what someone else tells you to do.
Yeah, I think the only example I can think of where incorporation is almost always going to be a positive. And bear in mind, guys, we haven't even scratched the surface on your usual thresholds. For example, if someone's earning under £50,000, I'm not going to ask them to incorporate no matter what they're doing, really. It's very unlikely unless they're trying to incorporate to look bigger or for protection or any other reasons outside of tax itself. So ignoring that kind of part of it, the only time where I go, yeah, that you probably want to, incorporate without too much worry is an NFT project that you're running. That is most definitely a business. So if if you're over X amount, call it 50,000, 70,000 or whatever it might be, so you're tax efficient, tick. If you want to look bigger, tick. If you want to separate your potential liabilities and everything else, tick. More than likely want to do that. Whereas if you're a general investor, I can't see why you'd want to. I really can't. Especially now, what's the tax rates going to or gone
So
to?
it's complex, mate. It's 19% up to 50k. Then over 50k, between 50 and 100, it's 20%. Then between 100 and 150, it's 21, and it tapers up that way. But the way they do it is they call it a marginal rate. So
Right.
yeah, it's a nightmare. So up to 50k, you'll get taxed at 19%, but anything over 50k, I think it's 26 point something percent to bring you to the marginal rate. So it's going to be, and it's not a nightmare from a calculation perspective. It's just a nightmare to explain to people how it works, because people think, oh, I'm paying 20% at this rate. Actually, you're paying 26% over this rate to bring you in line with the overall tax rate that you're going to be at. So yeah, it gets a bit complex.
Yeah, I can hear our listeners right now going, hold on, you just said it's 21%, but now it's 26% because it's margin.
Exactly, yeah.
And it's absolutely bonkers. I believe they took this out, and I'll show my age now. They took the marginal rate out from corporation tax the year after I started, or a couple of years after I started as an accountant, or a tax trainee, if you like. So I never had to deal with it. And it sounds like they're bringing it back in. And I think, yeah, you using the term marginal rate almost confirms that that's what it is.
It is 100% coming back in, and it's a bit, yeah, it's really hard to explain to people. It works. Quite often when I explain it to a client, I'll just say it works. Trust me, you get into the right tax rate. I can guarantee you that. It's just a real strange. They've used it before, so it's not strange, but it's a complex way of doing things that's hard to explain and hard for people to understand. And you're not, if you're sitting here thinking, I don't understand what you're talking about, don't worry, you're in most of the population there. Like you say, Jamie, it's because we've seen it before and probably, studied it or seen bits of marginal rate before to understand it. So yeah, I totally get it.
Can you imagine the sub sort of 25-year-olds working their way up to a managerial role and then get slapped with a marginal rate change for corporation tax, sitting there panicking because they just wouldn't have seen it before.
No, exactly. Well, I've seen it before, but I've never used it. And when I first got told about it, I was like, what? And then I was like, okay, right, I got it now. When I've done the calculation, it makes sense. I understand what you're trying to do. And in a way, you've made your life easier, but you've made my life harder. You've made every client's life harder to make your life a little easier because you want to do it a certain way so that probably your own software deals with it and I'd probably hazard a guess somewhere in HMRC they still had marginal rate software that dealt with everything, so they've just gone back to it for ease.
That's not a bad comment, to be fair. Again, the incorporating side of things and all the intricacies of it, I try and not delve into too much.
Yeah, so I mean, back to your point, there's a few scenarios that might make sense. The other thing is what you're going to do with the money, because if you're going to take it and live off it, or if it's a lifestyle choice, you're going to pay tax on it either way. So there's no point in having a company if you're just going to take all the money out because you're not getting any savings.
That's exactly it. Yeah, you want to start looking at some tax planning opportunities of do you want to take up to 50, 100, 125, pension planning, all sorts of in between, and it's all the juicy stuff within the crypto space.
Yeah, definitely. So all I can say is everyone's scenarios, there's so many different roads you can go down. It's important to seek that advice and speak to someone about it, and make sure. I don't mind if someone spoke to me. I don't mind if you go and speak to 2 other people. I'd rather you felt comfortable with the advice you got from 3 people. Don't just speak to one person and say their word is gospel, because I guarantee you I've seen scenarios where people haven't told me everything and they've gone somewhere else and got different advice, and I've gone, actually, yeah, if you told me that, that's exactly right. I also have had people speak to me who've told me what they've been told before, and I've gone, I don't really understand that, So, I had one recently who came to me, it's not crypto related, but came to me and said, I've been told not to incorporate, there's no point. And I didn't really understand the advice. There might have been something that I didn't know, but it's down to that. Get 2 or 3 opinions. You shouldn't get charged for that. That's important. I know Jamie speaks to people on a free consultation, and within reason, I will as well. As long as it's within reason and you want a quick piece of advice, there's no problem in doing that, because it builds a long-term relationship. But it's if you sit there on the phone for an hour and a half and try and tell me a life story, I'm going to be struggling for time, so I need to charge for that.
Just to caveat that, it's only sometimes free, Robin. Only sometimes free if it's through Twitter, for example. But yeah, if they want a meeting with me like you and I are chatting right now, it's going to be a little bit longer than a 5-minute text or a call. It's going to start getting silly. But yeah, multiple sort of viewpoints can help. It depends on your situation and what you see fit at the end of the day. But just to sort of summarize, because this half an hour has absolutely flown by, Robin. We haven't talked about anything that is new, i.e. not traditional, apart from specifics like liquidity pools, nodes, and rebasing tokens. So negligible value claims, tax loss harvesting, Section 104 pooling and bed and breakfasting, incorporating, all of that is traditional accountancy terminology and uses, aren't they?
Yes, definitely. So it's an ever-changing environment, isn't it?
Yeah, so it'd be interesting to see if something comes out that is specific to crypto. Something like, I don't know, tax loss harvesting for crypto or whatever it might be, or something where you can have a, what's it called? Holdover relief type thing where you roll over the base cost of one asset to the other. But yeah, that'll be interesting to see if that ever comes to fruition. But anyway,
I think there's so much that you've got a 30-page manual that's meant to cover everything, and it's probably one of the biggest asset classes out there, and yet it has got such a small manual. It's almost ridiculous to say out loud, and I think that's why you and I where we are now, because quite simply, what doesn't exist, when someone says, I think there's an expression, isn't it? What you don't know could fill a warehouse. Well, what you and I don't know could still fill a warehouse, let alone, what's already out there. That's why it's important to speak to someone that knows, because they might know the right approach if it doesn't fall into something else. So, we've talked about it before. I will review a smart contract if I have to go to that level to understand where the beneficial ownership lies, to understand how, that needs to be taxed in that scenario. And that's where you need to know that the expert that you're speaking to is in fact an expert on what you're talking about.
Yeah, couldn't have worded it any better, shall we say, Robin? Well, thank you so much again. We've come to not only the end of the episode, but the end of the mini-series with you. It's been an absolute pleasure. Is there anything you'd like to say to our listeners? Perhaps somewhere they can find you, follow you, or anything like that?
Yeah, so I'm on Twitter as the Secret Investor. It's at Secret Invest 2. I think, is my handle. If I've remembered that right, I've done well. Or my business is By the Book Accountancy Limited. Feel free to check me out on Company's House if you want to, do due diligence on who I am. www.bythebookaccountancy.co.uk, or you can find me at cryptotaxhelp.co.uk as well. But what you guys have just had in the mini series that we've done, and I'll be completely honest, you've had unbelievable value for what you've for a free podcast. I can't say that I can add hugely much more to that, but I'm happy to help anyone that wants to come, and if I can help, I will. If not, I can point you in the right direction.
We appreciate it very much, Robin. Your understanding and your knowledge around all this is incredible, and it's been an absolute pleasure having you on. Although I'm changing your name and my contacts to Eddie Hall ? After this episode.
Well, I appreciate you guys having me. Actually, it's been real. This is totally out of my comfort zone for me, so it's been really educational, but really, really good, and I've really enjoyed it.
Yeah, it's your first your third podcast technically now.
Yeah, it's the first time I've ever done a podcast in any way in this series. I've never done anything like this really, so yeah, it's us accountants can have a bad rep for not being able to talk, so I like to think we've done okay.
Exactly, we've got beards, we can talk, we've got tattoos, but we know our stuff. And on that note, thank you to our listeners again. Robin, can't thank you enough. Really been a pleasure. We hope you've enjoyed the episode, and perhaps we'll have Robin on again in the future. Enjoy. Cheers now. Bye-bye.
Cheers, guys. Bye.